And we have the head of payment services and global treasury product sale at Silicon Valley Bank, which is a preeminent regional bank in this area for those who know. And he has extensive experience. He's been a CEO of a Fortune 100 company prior, of a cards business, and across the board, FinTech and payments expertise. So he's in conversations with Sanjay Mody, a dear friend of mine. So please welcome Eduardo and Sanjay.
Thank you. Thank you very much, Eduardo, for joining us in this fireside chat. Eduardo and I have known each other and worked with each other in a number of global companies, and most recently also at Silicon Valley Bank. So our association goes back to Bank of America, JP Morgan, and then Silicon Valley Bank. And he's had a single-minded focus on payments and digital transformation that is happening in the industry since I've known him. If you remember, one of the earliest remittance products between US and Mexico, I forget the brand name of the product.
SafeSend.
SafeSend. He's the creator of that product in the industry. So it's that far back, he goes back in the world of payments. So it's a real pleasure to have you chatting with me. We heard this morning from Andrew Harmoning about the disruption taking place in the fintech space, right? And he showed lending was hot a year ago, but the area that he feels that is really catching on currently is payments, right? And so specifically, Eduardo, what are the latest trends you are noticing in the world of payments, e-commerce? And then once you describe the trends, maybe you can also talk from your perspective, with you having been at several banks, how the banks are responding to these trends.
Yep, very happy to. So I think what we're seeing is the disruption is very real, right? When you look at historically just banking and financial services as an industry, it's been an industry with significant barriers to entry, right? Which has led to very nice profit pools for the incumbents. And when you look at what the barriers to entry were, part of it is distribution, the branch network, very hard, very expensive to replicate, so that's a big advantage and big barrier to somebody trying to come into that space. Another is big economies of scale, especially around processing platforms, very expensive to set up. You need large scale to be able to do that competitively. The leverage of the availability of data that they have, say for example for underwriting decisions, right? They have sort of a privileged data that is very hard to replicate coming in. When you look at and then there's the regulatory side, right? They're protected. Right. When you look at some of those barriers to entry, at least 3 of them have come way down, right? When you look at, and maybe another barrier to entry is consumer inertia, right? Very few people, it's very cumbersome, very difficult to move her bank, and people were reluctant. When you look at the different ones, I mean, they've come way down over the last few years, which is what's fueling market entry, what's fueling all this innovation disruption. When you look at consumer inertia, I think after the financial crisis, right, consumers have lost a lot of trust and confidence in banks and are much more willing to do business with non-banks, even in financial services, right? Especially the younger generation. So that barrier to entry has eroded, right? That the inertia has decreased. Secondly, you see on the technology side and the economies of scale implicit in banking, those have come way down too, right? If you want to start a processing business, if you want to process payments, you can now just rent the space from Amazon, right? It used to be even 5-10 years ago to start a payments business, just to start a startup, you probably need about $5 million. Now you probably need maybe even less than 100,000 to start processing transactions because you don't have to buy all the service up front. So that's another barrier to entry that has come way down, right? The advantage of scale. A third one is really the advantages of distribution. with digital, with mobile, providing a sort of a platform for distribution for financial services. Suddenly the advantages of having a branch network have gone way down. So that's yet another one. And when you look at availability of data and processing power to do something with it, and there's just the explosion in publicly available data right now has really eroded the information advantage that banks historically have had to be able to make decisions around underwriting and the like. So when you look at all of those, you have basically a lot of new players coming in, a lot of entry, a lot of experimentation. Not all of them will survive. Definitely, as in everything in venture investing, it's a small percentage that survive, and it's very difficult to figure out who the winners are going to be. But those that do will have a profound impact. Is in particular about driving down revenue pools in the industry. The more entry you have, the more competition you're going to have. That's going to drive down margins for all of the incumbents. And then the challenge that banks face is twofold. One is they're left with an expensive infrastructure, legacy systems, branch network that don't provide the same advantage as they used to have at the same time that you have declining margins on the revenue side. So I think really the challenge for banks is how do you leverage the same technology trends that the FinTech startups are using around digital to really lower their costs, to simplify their infrastructure to be able to compete in that new world. I think the other challenge that banks have is just the governance and really the bureaucracy that sort of that enables them or prevents them to move quickly, right? If you're a FinTech startup and you want to do something, right, you shop your idea around 30 venture capitalists, and all you need is for one to say yes, and it happens, right? If you're working at a big bank and you're trying to get the same project funded, you probably have to go have 30 meetings, convince 30 people, and all you need is for one of them to say no, and it doesn't happen. So it is a structural difference, structural challenges that banks face as they try to be more innovative and compete in the new world.
Right. So you see a lot of disintermediation happening, right? And as you see, one of the plays the fintechs are making is that banks have typically focused on the front end of the client experience, but have not truly looked at end-to-end experiences and end-to-end client experiences, which is where the fintechs have created value propositions, right? What are banks doing? What are you doing to address, that disintermediation? Because very soon it can be that banks become the utilities of tomorrow, upon which the value creators ride and derive all the client experience and relationships.
Right.
So.
I mean, that's a real challenge for banks, right? Because when you look at the new breed of players, of the fintechs, very few of them have focused on the end-to-end process. The majority are focused on the front end. They're more like a new generation ISO, right? In that they're signing up the end customer, focusing on a really streamlined user experience on the front end. And then for middle office and back office, they're using a traditional processor, a traditional financial bank that has the necessary licenses to move the money in many cases. I think in terms of what we're doing, I think it's reality that we are in a new reality. Consumers feel very comfortable buying financial services from non-banks. That's reality. Reality is tech startups and fintechs tend to be a lot faster, innovative, and better at user experience than the big banks are. I think that's also reality. So I think the opportunity for the banks really is embrace that new reality, and really how do you build the platforms that enable the fintech players to do that on top of them, and make it easier for the fintech players to create on top of them, as opposed to just trying to prevent it and trying to just go back to the way We have no consumer operations. All we do is commercial banking and venture capital investing for the VC industry and for their portfolio companies in tech and biotech, including fintech. So in a way, the reason for being for us is to help the innovators and help them, right? So a lot of what we're doing is really building what we're calling banking infrastructure as a service platform, really, which is it's a banking platform and processing platform, including payment services, including access to information, with a set of APIs that developers can use to build their user experience on top of, right? So rather than saying, I have to control the last mile, we're saying, no, reality is our clients are much better at creating those user experiences, number one. Consumers want to buy from non-banks. And if they don't build it on us, they're going to build it on somebody else. So we should make it really easy for the fintech community to build on top of it. And a lot of it is creating the APIs that enable that.
Right. I was speaking to my friend Graham Seal this morning, and we coined a term called apification of banking.
Yeah.
It's coming with the chimp as the...
That's exactly right. I'll give you a couple of examples of where we've done that, right? One is we recently announced a joint platform with Stripe. It's called Stripe Atlas. And what that is it's a Stripe offering that is going beyond payments and creating a platform for companies to start their business. It's a place where that makes it easy for you to create your own startup. And basically, it's a platform that it helps you incorporate your company, and this is primarily aimed at global entrepreneurs and we're trying to make it easy to start a company and incorporate a company in the U.S. So it's going to help you incorporate your company in Delaware. It's going to give you legal services to help you structure the ownership structure and the equity structure in the right way. It has sort of accounting and financial services. It comes with Stripe to start accepting payments, so it's aimed at e-commerce. And it comes with a bank account from SVB, all in a box, all in a platform, and the integration of SVB into Stripe's Atlas platform is done through one of those banking APIs that we've been creating.
Right. Let's get a little narrower. So given all of this disruption, competition, cooperation, coopetition, call it, what's happening? What are the biggest opportunities, specifically in terms of payments? Commercial card as a vehicle for payments also is growing at double-digit rates, right? It's very well penetrated into the T&E marketplace, but the banks have tried for a number of years to use and to promote the use of commercial card in B2B payments. Can you talk a little bit about the trends there? Can you also talk about the prevalence of virtual cards in the B2B payment space or in the T&E space as well, and give us some insights?
Happy to. So in the commercial card side, I mean, there's basically two main flavors of commercial cards: the corporate card family, the T&E family, and then there's the purchasing card family for B2B spend, for accounts payable spend. I think the T&E side is much more penetrated. That's where the industry started. I think there's less, I would say, there's less innovation, less exciting new stuff around there. I think that happened earlier. The innovation there is much more about integrating, is much more about not so much the payment side, but much more the expense management side, integrating your cards with just expense management software that allows companies to manage that travel spend. It's more in that software space, enterprise software space. On the B2B side, that's where the biggest opportunity is and where the untapped opportunity is. I mean, B2B spend is probably 20 times at least bigger than the travel spend by companies, and it's much less penetrated on cards. I think within that space, the virtual cards are probably the more innovative, more interesting opportunity with the strongest value proposition. And what a virtual card is think of it, it's really a token, right? It's probably one of the earliest examples of tokenization. What it is rather than a company using a single card number for a single purchasing card number for all their B2B purchases, what it is it's a system that just generates a different card number for every transaction. And you call it electronically through an API if that's what you want. It could be web-based, but it could also be API-based. So we have an API SVB has an API for virtual cards as an example. And then it generates a unique card number tied to that transaction, which is only valid at the merchant at which you want to use it in. The credit limit is exactly the value of the transaction, and you use it once and the card expires. So what that gives you is basically a much stronger set of controls in that if you want to pay $95.99, the merchant, that card is only valid for $95 and $99. The merchant cannot charge $96. The card will be declined. So it gives you a lot more control over the value of the transaction. It gives you much more control about where the card can be used. So it has a very strong value proposition. And really what it enables clients to is to have straight-through accounts payable process where you can, when you integrate it with software that has workflow to approve a purchase by say you're going to buy office supplies. And at the very end, it calls through an API, that software calls through an API for a virtual card number that then gets delivered to the merchant. It really enables straight-through accounts payable process for clients. So it strengthens control, it drives process savings. So that's where we're seeing sort of the most of the innovation. We're piloting with MasterCard a straight-through pilot, a straight-through processing pilot for virtual cards right now, which historically virtual cards basically, once you generate the number, you send it to the merchant, and the merchant has to enter it and key it into, say, their online, their virtual terminal or their POS terminal to run the transaction, right? Just the way you give a card number over the phone to a merchant. In straight-through processing, what you do is when you ask for a purchasing card, rather than sending the number to a merchant through an email, it basically pushes the payment directly into the merchant account at their merchant processor without any manual intervention. So almost like receiving an ACH, but through the card rails with much stronger control and much better data. So that's I think where some of the exciting innovation is going.
Right. And this is an area that is typically not yet, if I may say so, not yet under attack from the fintech industry.
Yes, I think in the fintech space, I think where we've seen, I think you're right, but that is changing. We're starting to see some exciting innovation around virtual cards, some of it in Europe, some of it here. But I think in the fintech space, I think where we first, or in the payment space at least, where we first saw entry was much more on the consumer side, both on the merchant acquiring, the players like Square, for example, as well as on the card side, but much more like the wallets, right? It's much more aimed at consumers. We're then seeing, as that space becomes much more, I wouldn't say commoditized, but like I think there's more that has happened for a long time. We're starting to see that innovation shifting to that B2B side, so we're starting to see some of that. I think the challenge that we see for startups and for fintech startups in this space is anytime you go into the B2B space, there's longer sales cycles than in the consumer side. So a lot of the players, as a way to go around that, where we're seeing the innovation is much more in taking enterprise kind of solutions and bringing them down to small business. So it's more in that small business B2B side where we're seeing the innovation. In that on the larger corporate space, because of the challenge with longer selling cycles, we've seen less yet.
Good. Eduardo, you started touching a little bit of the disruption on the point of sale, on the acquiring side of the business. There's increasing, as you said, it's still not commoditized. It's still increasing adoption of wallets and the like. Can you talk a little bit about the disruption, particularly at point of sale?
Yep. I think on the point of sale, so let me talk about just the two sides, right? The receiving the payment as well as the making the payment at the point of sale. On the receiving the payment, where we see some of the more interesting disruption is more on the e-commerce and online space, right? You had earlier disruption into physical point of sale, right? The Squares of the world, the Clovers of the world, the iPad or iPhone enabled cash registers or point of sale terminals. I think that has continued, but there's enough of that like some of the newer players are more Me Too kind of offerings. We haven't seen anything too different in the last year there. In the e-commerce side, on the e-online side, players like Stripe are doing some really interesting things, and it's all again going back to the APIfication of the industry, where all that Stripe is this amazingly simple API with amazingly simple onboarding process and instructions for how to use it that enables a company, an e-commerce, a developer to start accepting payments in a day, right?
Right.
So they're not trying to control the end user experience. They're just providing this very simple experience aimed at developers. I think that's where the exciting innovation is happening. So that's on the accepting payment side. On the wallet side, I think I personally am a bit bearish, and we're not seeing significant adoption outside of the early adopters, right? I think when we look at the usage of Apple Pay, when we look at the usage of Samsung Pay, yeah, you had significant adoption at the beginning, but we're not seeing the radical growth in usage. We're not seeing, it's just not there.
Right.
And I think part of the challenge with wallets is, in many cases, and in most cases still, they are a cool technology looking for a problem, right? When you look at payments, paying at the point of sale in a physical store, which is where these wallets have initially focused on, it's actually taking a piece of plastic out of your wallet and paying at the point of and swiping it. It's actually a very fast, very simple process.
Right.
And most consumers, beyond the cool factor of trying Apple Pay at the beginning, seem to be still using plastic a lot more. Even those that are enrolled in both programs, they revert to using plastic even at merchants that accept Apple Pay. And I think part of the challenge is just what's the consumer value proposition?
Right. An old friend of mine, sitting right next to me, once said, it's not about the payment, it's about reducing friction. And that, I think, reinforces the point you're just making, that at the point of sale, a consumer doesn't feel a lot of friction taking the card out and swiping it, as opposed to using the mobile wallet.
That's exactly right. I think on the online space, there's more interesting, use cases, because especially when you're paying on your phone, entering card numbers on a little screen with your thumbs is cumbersome, right? So wallets that save your payment information as a token that allow you to check out with your thumb rather than having to enter all the numbers. That's where we see the adoption. That's where we see the interesting use cases.
Right. With all of this going on in the B2B space, and we talk about a lot of this e-commerce happening domestically, global payments still is a challenge from a B2B perspective. And yes, there are some players that have emerged, Earthport being one of them. And banks have also tried several times to integrate all of this e-commerce activity that may be happening domestically also with a merchant's global receivables. Any thoughts, any ideas, global payments, global receipts? What are we doing? What are you doing, SVB, specifically about solving that?
That is a huge opportunity. And it's ripe for disruption because of how inefficient it is. It's not an easy problem to crack, which is why, I guess,
it hasn't been cracked.
It's so inefficient and it's ripe for disruption. But whoever cracks there's a real value proposition there. I think just the process of sending a payment cross-border, it's so opaque. There's so many hands in between. It's so expensive. It's so inefficient. I used to live in London paid taxes in the U.S., and had accounts in both countries. And every now and then, I would have to send money from my account in the U.K. to my account in the U.S. and just wire money to myself so I could pay my taxes in the U.S. And I remember one time, it took, and I did it through just my bank at the time, it took 2 weeks for the money to get here between HSBC and JP Morgan. It was, at some point, nobody knew and nobody could tell me where the money was. The money had left my account at HSBC. The money had not hit my account at JP Morgan. I called HSBC, and they said, oh, we gave it to JP Morgan. JP Morgan didn't know where it was. It literally took 2 weeks until they found where the money was and to credit my account. The exchange rate and the cost was obscene.
Right.
And so when you look at players of the like the likes of a TransferWise, for example, so next time I transfer money to myself, I use TransferWise. It was simple. It was a lot less expensive. I knew where the money was. I mean, there was a very strong value proposition relative to the bank. So that's definitely an area where there's an opportunity for disruption. I think on the B2B version of that is where the biggest opportunities are, right? I mean, you've worked in correspondent banking and managed correspondent bank networks for a long time, Sanjay. You know how difficult it is, right? And you can't be a low-value clearer in every single country. At some point, no matter how big and global you are, you're going to rely on a network of correspondent banks.
Right.
And it is unwildly to manage those. And that's where the different handoffs happen and where it's impossible to know where the money is and provide transparency to clients. I think the real opportunity is, I think where we see the airports of the world today and some of the other kind of players, it's almost like outsourcing your correspondent bank network. Somebody will take that complexity, but all they've done is negotiate a correspondent bank network themselves, right? But you haven't really, so while it's an improvement for some players and some use cases, they haven't really disrupted or changed how the money moves, and which is where some of the opportunity lies. So whoever can crack that, that's a big one.
What about all, the card rails globally? I know receipts and payments are happening all day long. Are there opportunities, rationalization, or anything you see where a merchant anywhere on the globe, let's say a US merchant, can collect globally in multiple currencies, and vice versa, an Asian merchant can collect globally no matter where the sales are? And are there efficiencies to be harnessed in that space?
Yeah, I think there's some.
On the card side.
Yeah, on the card side, I think that's an opportunity too. I think there's very few true global players that enable true merchant acceptance and settlement around the world, right? I think the acceptance piece is the easy one, right? I can, with FX contracts, I can give you, with settlement in US dollars, I can give you acceptance in 150 currencies, right? It's a matter of just quoting the right currency to the client at the point of sale and processing the transaction in that currency. That's the easy part. It's the settlement in the different countries for more global companies that have a more global cash management kind of structure and want to be settling their Japanese transactions in Japanese yen because that's part of their cash management strategy. That's where you have very few players with true global platforms. You have an Adyen doing some really interesting things there. You have First Data, more of a traditional kind of player, actually coupling several platforms around the world trying to get there. You have Elevon is probably one of the more global, more innovative companies there, but it's really that infrastructure, that settlement piece. It has really, you still see a lot of economies of scale in that back end piece. More barriers to entry. So I think outside of an Adyen, you still have more. That's more dominant. The innovation is more driven by traditional players still.
Okay. Taking you back to your years in London, there's clearly a lot of regulatory push in Europe and in UK to promote disruption in financial services. So can you talk a little bit about the type and pace of innovation and disruption between US and Europe and UK in particular? UK put a faster payment scheme, in fact, regulated that faster payment scheme be implemented by the banks. So now we have a payment scheme in the UK whereby you can settle in a couple of hours. You can send money to a recipient and they can get the money in a couple of hours. And in the US, we still have to wait overnight for funds. So can you talk a little bit about the pace of adoption?
Very happy
disruption?
Very happy to. I think when you look at innovation in fintech in the US versus the UK in particular, I think very different approaches. I think London has long been, together with New York, a global finance hub. And I think after the 2008 crisis, where you had RBS had to be rescued by the UK government, right? And you had a whole bunch of different players having to be rescued. I think that loss in trust in banks translated is definitely is even stronger in the UK than in the US, which has led to much more activist kind of regulatory stance by the UK government. So the UK government is on one hand trying to has lost its trust in the banks, but wants to keep London as a global finance hub. So they've recognized that, hey, finance is being disrupted. There's a new breed of player that is a non-bank that is threatening the traditional banks, which, by the way, we don't like. So let's help establish London as the preeminent fintech hub. So what the UK government has done is basically industrial policy, activist industrial policy to help promote and help winners in the fintech space, which is something the US that hasn't done. The US has taken a more hands-off approach. Fintech has happened just pushed by the traditional venture model. And then once a few grow, then suddenly the regulators are realizing, oh, maybe we should look at this. The UK government has been the opposite. It's like they're trying to push it and try to have London come out as the winner. So that's one big difference in the regulatory stance. The other big difference is a lot of the innovation in the US and the fintech side has been much more, for the most part, again, innovation on the front end of the user experience, but relying on the traditional sort of channels and rails on the back end. In the UK, you're seeing a lot more of just bypassing the traditional channel, the traditional card channels in particular, and leveraging much more faster payments as the rails behind on which you're building all the innovative front end experiences. And then lastly, there's a whole dynamic around just for the European Union on top of that, right? The PSD2, the Payment Services Directive 2 for the European Union, that is entering in effect in 2018, basically takes. What we were talking about before around, hey, barriers to entry have come down just naturally, but due to consumer attitudes, technology, et cetera. Well, here is the government is actively pushing down barriers even further, right? By essentially forcing banks to give access to to initiate payments, access to the information through a set of standardized APIs. So in order to initiate a payment, you don't have to be a bank anymore in all over Europe. You can just register as what is called a PISP, a payment initiation service provider, and you're going to be able to dig into banks' accounts and push a faster payment without being a bank. That's new, right? And so in terms of the barriers to entry, that's just way down. You don't even need to be a bank.
Right.
Banks will be forced to open all their information and make it available to what is called an AISP, an account information service provider. So it's a new category of financial player that, not being a bank, banks will have to give them all the information. So banks lose that information advantage too. So that's going to have dramatic impact on entry and creation and innovation of a new kind of player, as well as on the margins and the pricing.
I mean, it's very, very interesting. I mean, with the AISPs, I think the regulators are pretty much forcing account number portability in a virtual fashion, right? One of the things that banks have is your account number. Well, the account number will no longer be primarily owned by the banks, because the AISPs can use that information to move money, right? So there's a lot of change and disruption yet to come. And with that, I'm afraid we've run out of time, right, Patty?
Yeah, it's a fascinating discussion. We could go on a little bit more. The next session starts here in about 15 minutes, so we have time if you want to take a couple of questions from the audience.
We'll be happy to take Mr. Hunkley.
You want to use the mic just so that
Dave,
we
if you
record
don't
it?
mind.
We're recording the event.
So just to introduce, Dave is from the Norman Group. This is a consulting firm also in payments and digital transformations. Dave and I have worked also for many years together. So welcome, Dave.
Great session, thank you. My question is around when you think about all the disruption and what's happening in payments, clearly you're in an advantaged position being able to enable the technology providers and still benefit from the e-commerce transactions that are flowing through on your payment rails. What do you think the discussions need to be across the industry relative to the revenue streams and the fee income opportunities around payments and how that changes going forward? Or what discussions are being had out there? I don't hear a lot of banks talking about, when they look at the revenue mix that they've enjoyed from payment streams in the past, what are they doing to adapt to this API banking world that we're in now?
Yeah, I think the industry has evolved, right? I mean, the industry has realized disruption is real, and there's a challenge. And I think the response varies by player, right? Players with big traditional legacy portfolios are going to be more concerned about the cannibalization, of course. Players that don't have that legacy portfolio are going to be much more aggressive in promoting the new kind of player. I think where you see the response from the banks vary is, so I think what we're hearing is banks have realized they have to do something, right? And every single bank wants to have an office in Silicon Valley, and every single bank wants to partner with the fintechs. I think where I think banks are not very clear at times, or sometimes you hear things that it just, you don't hear a lot of clarity, is what's the purpose of working with the fintech providers, right? Are you doing it because you want to promote innovation in fintech and you want to help them and you want to be the one that they're building on top of? Or are you outsourcing R&D? And you know that your IT department cannot move quickly enough to create a compelling user experience, so let's just have somebody, some quick little nimble startup, do it for us, and maybe we'll buy it after the fact, right? So I think there's a little bit still of you see different responses that sometimes they say one thing, but they're doing another thing that it's just not, you don't have the clarity, or you don't hear the clarity.
I think I would probably add to this if you take, and I'm sorry, I'm going to cite some stats on Silicon Valley Bank, but their payment revenue is growing in the 20s, all right, and in certain products is as high as 40%, all right. So it depends on who you are, what you're doing, and where you're growing your business, right? And plus, of course, the client segment itself. So there is significant client growth, which obviously provides you the payment growth and therefore the associated revenues. But on the other hand, product plays. There are concentrated product plays, choices that banks are making, saying, we are going to go here, and this is where our focus is and our growth is. Eduardo at Silicon Valley Bank is focused on partnering with fintechs. They are a catalyst for disruption rather than afraid of disruption. So a lot of possibilities emerge in terms of business models and revenue opportunities. Right?
One last question.
Thank you, great session. So when we talk about payment innovation, it's moving money faster and managing the risk. So specifically, if you can tell us, what is Silicon Valley Bank doing to manage that risk part, right? As money moves faster, the risk is high. What are you guys doing to manage that? Thank you.
I think on the risk side, I mean, there's different elements, right? I think what the most important part is to be able to process it in real time in a scalable, simple way, right? If you're going to have a lot of innovators, potentially think of a Stripe that grow very, very fast. Your risk, the way you manage the risk cannot be the traditional one with lots of manual processes. It needs to be all straight through. I think on the risk side, I mean, it depends a lot on the product. It depends a lot on the company, right? I think we our risk comes on the merchant side, comes on the card side. On the merchant side, it is really a combination of merchant category and having in there we partner in having good data around likelihood of chargebacks, likelihood of merchant fraud. And there what we do is we partner with traditional players. We have a partnership with First Data. They see 35% of merchant transactions in the US, and we get access to all that data and their models to understand what's the likelihood of chargeback risk. We append that with what's the likelihood of with our understanding of credit risk, right, for our clients. And then credit risk, that's I think where we have some, because all we do is work with startups and their investors, and that's all we've always done. I think we have some unique, I think the unique IP for SVB is being able to make underwriting decisions and credit decisions for companies that sometimes have no revenue. Most of our clients, I mean, an average startup takes, I don't know, 5 years to get to profitability. A lot of our portfolio, at least half our portfolio, hasn't gotten to break even yet, right? So I think where we have unique modeling and insights and analytics is on how do you make those credit decisions for companies that are pre-revenue or companies that are pre-profit. So we append that with some of the industry data to make our underwriting decision, and then trying to automate that into a straight-through processing so that you can quickly feed it into our clients' APIs through an API.
Rajesh, on payments in general, I did a study once that if you are a business and you access, I'm not talking about consumer, I'm talking about a business payment. If you initiate a payment on an online banking platform that you are using as a client, so firstly, we have to, as banks, have a lot of technology deployed to ensure that you are authenticated, okay? That you are who you say you are. I mean, there are at least 5 types of technologies that are engaged in that process to validate you, to authenticate you, and then to determine whether you're authorized to do what you're doing. There's all kinds of technologies doing that. So now that you entered the house, right, so to speak, we have to make sure you go to the right rooms in the house, right? So there are other sets of technologies where we can investigate for fraud. Is this fraudulent? And we have software that determines fraudulence. We have software that now is checking whether is this probably a money laundering kind of a transaction, right? So there's a lot of intervention that happens. All of these technologies come together in a symphony, right? And we've tracked from the point of initiation to the point it goes out of the bank on a transaction like that is 20 minutes. Okay. So that's how all of this comes together, yeah? Okay. There's manual intervention because sometimes some things, software is always going to give a signal. The signal has to be investigated. That's why the 20 minutes. If it was purely goes through all the filters in the software, it's in seconds. It's not even. There are scoring, there is signals, there is software that monitors traffic, there is REDs. I mean, you can imagine the kind of software. So, okay.
Yeah, and a lot of what we do is also partnering with our clients, partnering with fintechs to do that. Like,
right.
So I'll give you a perfect example. We're doing a pilot now where there's a client of SVB, and they have just geolocation data that's a lot more precise and more battery efficient than GPS. So what we're doing is plugging our clients' technology together with First Data's fraud decisioning engine for a card transaction, so that when we authorize a card transaction saying, is this Sanjay using his corporate card in London, yes or no? Well, we're going to be able to, in addition to use the traditional logic that First Data has, we're going to have a fintech provide the location company of his phone with a lot of precision and say, here's an additional piece of information that First Data can use to construct that score to say, likely I think it's Sanjay. No, I don't think it's Sanjay, right? So I think that kind of marrying and partnering with our clients, partnering the incumbents that have real data advantages, and bringing that to provide a better user experience, I think there's a real win there.
Okay.